All right, thank you. You asked a common question. A lot of small developers or big developers doing small project. All right, they are trying to get residential loan for potential commercial development sites because purely maybe because they haven't been exposed to commercial high interest rate, low LVR product, and also capitalized interest. All right, or maybe they try to lower the finance cost. Right. But we want to give the clients A, more certainty, B, of course, we're trying to save them money as well, but in commercial, it's more certainty. So, for example, this is a site on the market that is selling, uh, that's 2024, selling now, but 2021, you can see that the current owner purchased that and then got a permit for 5 units. All right, and then try to sell it for 1.3 plus. Of course, I'm not sure the result yet, right? Oh wow, the first one's a winner, 20 years, 10 times almost, not 10 times. Okay, so what's the difference between uh so the commercial and the residential, for example, or metrics? Let's compare the metrics. Here's the residential part, here's the commercial part. Of course, the rate, for example, as of today, let's say circa 6.5% interest rate, variable for investment, that's the rate. For commercial, if we're looking at the banks for development, it's 7.2% rate plus 1% line fee plus 1% setup fee. That sounds quite a lot, right? If it's non-bank, if we take the Trove, for example, all right, it is 9.99, which is almost 10% starting point, plus 0.9 fee, 9 fee, plus 1.5% extension fee. So that's the cost difference, right? Of course, there is QS fee along the way as well. All right, QS fee setup plus monthly. So quite a lot of fees. Then term is another key difference. This is a 30 years mortgage, right? But then the intent as well to the lender and to the developer is build to hold. This is build to sell, right? So hence why the banks can't earn the long-term interest from you. So 18 months or a fixed contract term plus 3-month buffer. So it means if the builder sign 15 months with you, then plus 3 months will be 18 months. If the builder sign 20 months, it will be 23 months. Okay. All right. So that's one. The next difference is how the interest is paid. How the interest is paid. This interest is paid monthly. This is capitalized. So capitalized means take all interest from day one, refundable if complete the project early, right? If delay, we need to renew, right? Let's say 3 months, then you're gonna pay that 3 month interest upfront, and then the lenders will extend the facility for you. Okay. Uh, the other difference will be LVR. It is a maximum up to 80%. All right, but if the loan size greater, depends on the lender, right? 2 or 3 mil, 2 or 3 mil, it may drop back to other LVR, right? Also subject to property type and postcode. This one LVR have two meaning of LVR. One is NRV, GRV minus GST, which means net realization value. Let's say 75%. And then another LVR, which is usually more commonly used, is called total development cost, or LTDC or TDC. That simply means land plus build, right? Not including GST, excluding all GST. or the GSC here, and plus portion of the professional cost. All right, such as architect, development approval, land surveyor, all that. Okay, that's the LVR. So also the total development cost can be anywhere between 50 to 80%. I know some people will say, yeah, I can get above 80%. All right, but that's not the key. All right, the key is to selling the right metrics first. Okay. QS, and of course this is plus value. All this is extra cost. Right. Number of units. You ask this a lot as well. Number of units. How many units? If I build 4 townhouse to hold, is that feasible? This is usually up to 3 units. I know some lenders may go up to 4 or 5, but mostly only 3. And if you go up, say 4 to 5, then can you get 30 years mortgage? Maybe you can. We have case study like that, but we don't want to oversell it. So what's rather is usually, 3 plus will go to commercial, right? And holding structure as well, SPV holding. This time, the metrics become very long, right? Let me make the type smaller. Right, let's call this for now. Individual or SPV, all right? SPV only. Cannot use individual or individual trust. All right, pre-sale, it goes along and long, pre-sale, if you want to get residential, you have to pay a lot of tax. You have to demonstrate enough serviceability. If you do commercial, you can cover by pre-sale 100% or less with non-bank from 0, okay? You can start without a pre-sale. Then you immediately saving a lot of cost for marketing and agency cost. The current market of the plan, agent may charge you 4 to 6% plus marketing fees, say $20,000. But if you complete and sell, A, it's much easier. B, you can sell for higher price to drive those in motion. People see that property being built, so new, so nice, and then you only pay the agent 2% or less. All right. So anyone got any questions regarding residential versus commercial product? No? Okay. Another common question from the developer is, oh, can I in this trust special purpose vehicle, we have do we put in unit trust or do we put in family trust or discretionary trust? All right. Look, the answer or the scenario is it really depends. If you want to get residential loan, given that if it's under 3 units, it is best to just keep it simple, one applicant only. That's one natural person, which means one director, one shareholder, and his discretionary trust or his trust by himself or herself. Because if you show a unit trust between, usually unit trust is between, not between spouse, just between business partners, right? Say 50-50, all right? It immediately demonstrates to the lenders that you are going to develop these sites. They can't earn 10 years mortgage interest from you in the next 30 years because on average people hold property for 10 years. They can only earn 1 or 2 years. So then they will be losing money and they don't want to lose money. All right. And you want a healthy relationship with the lender as a developer. So residential loan, if you want to, I want to buy time, I haven't got a permit yet, I'm in these circumstances. So maybe you can try to flip. If you try to flip or trying to develop yourself, I will advise always, I'll suggest always use SPV set up for this project only. Okay. Residential loan. And also, some people try to get away from commercial, because what worst case scenario, all right, in worst case scenario, they give me a, let's say option one, I want to get, 80%, 6.5% interest rate, PN9, and no application fee, uh, and I want to get free val, no QS, free, that's it, everything lowest cost. And they don't even want to pay tax. All right, no, you can't. All right, so you have to demonstrate um serviceability. Okay. So option two is the soon they find that this is land banking. All right, land banking can be different word, but in this scenario, basically means they're gonna give you 50%. The bank's not gonna lend you money usually. A lot of banks they don't do land banking unless you demonstrate serviceability, and also intend to hold for long term. So that's the worst case scenario. You fell through, then you go to a non-bank to go for 50% LVR, 10% interest, plus 1.25% settlement fee on average. For example, take a little bit example, and then you only get 1 year, right? And you may be paying monthly or capitalized interest, depends on what kind of income documents you can demonstrate to the lender. I know, yes, some lender may borrow more, 65% or more, but as development consideration, you should really reserve your cash for the later stage rather than being very thin, right? If you only have 20% to get to the game, then this is probably not for you. Right, so land banking, how do I avoid that? All right, the developers say, I really want to hold it for long term, maybe 3, 5 years, I don't want to develop. So criteria is that you should, for valuation, let's talk about valuation. If you really want to sneak through or hold it for a long term, you really don't want to develop yet, right? Criteria for residential loan, right? Of course, number one, prefer to have a short form residential valuation. But then sometimes you send out the valuer, they don't want to do the valuation. The residential valuer will say, sorry, my PI insurance doesn't cover that. I haven't been trained for that. This is not looking like a residential property. Let's go back to this property years ago. If the property condition is livable, then yes, they may approve that. But usually if you see this kind of advertisement, they have no photo inside, it probably means the interior condition may be very bad. But if it's still rentable, they can still accept it as residential. But then if it become loan form, this is expensive. It's going to be a few $1,000s. And the client's going to pay for it. And depends on subject to comments, right? If the valuer is very conservative and he or she said this must be a highest and best use, right? Sounds like a dirty words to a lot of developer during this game. So then you go into land banking product straight away. All right. You go to land banking product straight away. All right, which is the banks don't do it unless you demonstrate very strong servicing. But if you already have permit like that, residential bank won't do it at all. All right. They would prefer to give you a commercial product, maybe a commercial bill, right? Or commercial bill loan, which is the cost is between option A and B. We also have scenario where clients trying to build 5 townhouses, build and hold. So what they get is they don't require pre-sale. So they get this one from big 4 banks. And then after completion, they jump back to the left-hand side. Okay. But not many people can demonstrate that strong service. So that's loan form. All right. If the loan form didn't say highest and the best use, then you can potentially still go back to option one. Okay. Keep that if you have planned to do the renovation for the site and then rent it out. Of course, some developers, they very smart, so they keep the existing building. For example, they don't build 5. What they may do is let's say, for example, just make an assumption. So for this property sites, let's say unit 5 is the existing building. Rather than knock down and rebuild, what they do is they do renovation, right? And then they have a big vacant land here, and then they can subdivide the title first, or build these 4 units, but then the permit will keep the unit 5. Unit 5 is the existing building, and they only need the construction loan for unit 1, 2, 3, 4. Look, since it's more than 3 units on one title, so the bank still carried concentration risk. So hence why most likely still going to get in commercial short-term bill or short-term loan, and they're going to get paid higher interest rate. All right, so the banks in a nutshell, all right, if you want to sneak through the criteria, what's the criteria? There are multiple criteria, and different valuer and assessor have different opinions. So we cannot guarantee all developers, they try to develop maybe in a longer term rather than shorter scale. If you come in with this, it's commercial straight away. All right. Unless, of course, it's commercial construction straight away. If you want to build and keep, that's another story. So your true intent is very important. What's your true intent, Miss customer? Please be honest with me, and let's see how we can sell it for it. Number 2, and you can't make the banks lose money all the time. You burn the credit history as well internally. So true intent. Number 2 is valuation status, right? Especially risk comments. Right? Are they highest and best use? If you're not happy with value A, you can ask value B, and then you pay 2 valuation fee or even 3, but they may be very similar to each other. Yes, I know some of the valuation results can be 10% or more difference in the valuation, but in this case scenario, the risk comment is more important than the result of the numbers. Number 3 is that, do you have serviceability? If you are doing multiple developments at once, or you're doing more and more, doing commercial is not a bad thing. Because doing commercial under non-NCCP, it's actually easier to get a finance, right? And it's actually easier to leverage through, right? I have developer complain that, oh, this commercial loan looks like I need just 50% cash upfront because I need to pay all this upfront interest. I say, yes, that's right, but you don't pay monthly. And it de-risk your project as well. Right, so number 3 is serviceability. Number 3 is really the numbers of units. If you're doing 20 townhouses, it's too far. You can't say you're going to build 20 at home. You probably can. But then the banks, remember, they have these 3 units in one title concentration risk. So even if you're building 20, say, apartments or townhouses, and you can't just retain 20 and ask the bank to give you a residential loan, 6.5 over 30 years. They're probably going to give you a commercial loan at 50% LVR, 6% each interest rate. So, and then 2 to 3 years loan, because the lease is to 20 tenants, right? So there is vacancy rate that you can see. Right, so that's the nature of the project, right? That's also important. Of course, the holding title, the title holding entity, and SPV, however you want to call it, right? So we also have instance where the customer purchased a site years and years ago, under individual name, and then 5 years later, after settlement, he or she find out, oh, maybe I should get a permit, and then get a permit for 5 units, right? And then he tried to go back to the bank, and the bank said, sorry, even though we can't give you a commercial bill because unless you provide very strong servicing, unless you're providing very strong servicing. Otherwise, if your strategy is to sell and try to get a commercial loan with the bank, they can't approve you. You have to go to non-bank with no pre-sale. All right. So market condition, serviceability, or pre-sale or pre-lease. All right. So that's quite important. How someone's gonna get paid. Right. That's pretty much in a nutshell. Pre-sale, pre-lease. So also maybe to this point, commercial, if I want add on one more criteria is the builder selection. So of course, if you're doing commercial, the banks will protect you more. They will do more DD. They will ask for 3 years financial from the builder, and they will even ask for tri-party agreement, right? Party agreement, right? to have a more formalized relationship and de-risk the project if any of the three parties go bankrupt, is protecting the other two. It can be the lender, it can be the builder, or it can be the developer. They just want to ensure at the end the project can be complete. Whoever get kicked out, the other two party will try to get in. Was their responsibility to ensure the project can be completed. So whoever purchased that will have the product at the end. Right. So this is a very quick 20-minute split, and of course, in different case scenario, the clients may have different priority or circumstances or risk appetite and experience, and different shareholders situation as well. There are other more creative way to structure the deal in terms of JV structure, but it's really case by case, depends on the stable market and the team experience they have. Right, so I'll stop recording and then you can ask questions.